What we want to talk about today is really kind of lay out the groundwork for what we see as the potential for grain markets going forward. How do we get to where we're at today, and what do we see going forward? And like I mentioned earlier, we want to spend some time diving into strategies and things you can think about in your own farm situation. The Farm Financial Fitness Bootcamp is a great tool, great assets of videos that are available in the coming days. So I hope you'll take time to not only join the live webinars like we're doing this morning, but also come back and circle some of the training videos and educational material that we put together. Our marketing team, like Kelsey and Allison and others, have done a remarkable job of putting this together. What do we want to do in the next 35 minutes or so is, first of all, just give you a quick update on what we see as the key drivers for the grain market. And like I said, Regina and I will circle back and look at that poll that you just did and talk to you about what we think are good strategies, good ways to approach 2020 crops, and also take a look at 2021. And then finally, Regina is going to also talk about our approach to grain marketing at FBN. Just as a means of introduction for those of you that don't know us or haven't seen us in your local markets, we come to your areas a lot through crop marketing. But I'm Kevin McNew. I'm FBN's chief economist, and Regina Givolo is also our senior analyst who works a lot on not only U.S. wheat, but also in Canada as well. So I'm going to start by kicking it off and talk about where we're at in corn and beans, and then I'll kick it over to Regina for wheat. But what I want to kind of do is just kind of lay the groundwork of what I think is a recipe for a rally. And by that, I mean more than just a few days. I mean a prolonged, protracted rally that can go on for quite some time. Right now we're probably sitting about 2 to 3 months into this rally, starting somewhere in August. What is it going to take for the rally to continue? What's going to take for a really prolonged and protracted rally? There's kind of 3 key ingredients I see that go into this recipe. First of all, you need inventories to be declining kind of systematically. Then, if we look at USDA's monthly report on stocks, not only global and US stocks, you want to see those inventory numbers, those carryout numbers declining. Maybe not every report, but certainly kind of a systematic trend of lower inventories. Secondly, you need some sort of demand expansion, and by that I mean something that's new, something that is expanding and giving us more disappearance on the balance sheet. So it can't just be a short run kind of supply situation. That'll give you a short run rally, but to have a kind of long-term tail, a long-term rally, you need something with a demand kicker to it. And then the third ingredient I think that goes into this recipe is that in the US, we have to have prices that are relatively cheap compared to the rest of the world. So keep in mind these 3 kind of what I'd call necessary ingredients for a prolonged rally. And you're going to see as we dive into this that these are kind of the things we're seeing today. So I think there's a lot of room for optimism here. So let's start first of all with corn. And, if we think back into March and April, we were just, starting to get into the COVID situation. Ethanol was really sort of in the tank in terms of their production potential. We saw really large acreage. We got the growing season in the US off to a fairly good start. And so we had carryout numbers early in the season that were looking really, really bad. If we look at the numbers today, carryout numbers based on USDA, somewhere around 1.7 billion bushels of ending stocks. That's a sharp decline from where we started back in, say, May, when the carryout numbers were like 3.3, 3.4. So we have fundamentally changed the outlook because of, first of all, some supply disruptions, but also really, really strong demand. And so, these numbers I think are exceptionally supportive, but we also need some other things to sort of line up for us to continue to see price strength as we go forward. So not only in the US have we seen a decline in stocks, but we're also seeing it globally as well. If we look at the rest of the world, this is over the last 3 years. You can see carry out in the rest of the world, 110 million metric tons just 2 years ago. Today, sitting around 97 based on latest USDA projections. Even China moving lower. Now, what I would caution is this 192 million metric ton number for China. I don't think I believe it. I don't think most people believe it. We don't really know what China is. But what we do know is that China's stocks are declining. If we look at kind of the last decade of China, what China did starting in 2000 was really start to subsidize domestic production of corn. And so what happened as a result of that is their carryout numbers or their stocks numbers started to balloon really sharply. And by about mid 2013, 14, somewhere in there, they realized this was really a bad policy. They were building this massive inventory of corn stocks, and it just wasn't efficient. So they actually removed their subsidy for corn production. And this bar chart is basically showing the change, year-to-year change in corn stocks in China. And of course, they've been going lower over the last 3 years. And again, I go back to this 192 number. I don't necessarily believe it because we are seeing China really start to increase corn imports. So if we go back just 2 years ago, they had very few imports of corn, about 3 to 4 million metric tons. And even before that, they had zero back when they were at the height of growing a lot of corn. So their deficit on an annual basis is probably somewhere around 25 million metric tons. And chances are their stocks are probably somewhere to the point of just pipeline supplies. They don't have excess supplies in inventory. So they are going to have to meet any sort of excess demand, which in this case is 25 million metric tons, by imports. And we're seeing that this year. We're seeing expected imports at 16.5 million metric tons. That's up from 7 million metric tons last year. So this, in my opinion, is one of the biggest demand stories for corn as we move forward. Remember, item number 2 in our recipe is we need a new and prolonged demand kick. Suddenly grow more corn, they're probably not even going to go back to subsidizing corn production. So I think this is something that at least for the next 2 growing seasons, I think has a lasting impact on our situation for corn. The other thing that I mentioned in our recipe was that we need to be in the US relatively cheap. We need to be cheap compared to other competitors, other suppliers in the world market. And if you're an FBN market advisory subscriber, you see a lot of this data in our newsletter that we put out every weekend. Basically it shows how is the US price of corn compared to international prices that we sell against. And so here we have Brazil, we have Argentina, we have Ukraine, all 3 major competitors to us in the world market for corn. And as of last week, we saw US prices somewhere around $4.95. This is at export origins like the Gulf. And we can see that Brazil was $5.98. So basically, we see our competitors well above us in terms of prices. That's good. What that means is we're cheap. So even though we've seen prices go up, our competitors are much higher than where we're at. And if we look at kind of the year-on-year change, it's a totally different story today versus where it was a year ago. A year ago, we were closer to on par with other players. We were only about 25 cents a bushel cheaper than Brazil. Today, we're $1 cheaper than Brazil. Likewise, Ukraine, we were discounted, or we were higher priced than Ukraine, and now we're well below Ukraine. So these are, again, a good reason for us to be optimistic about the future, at least certainly the near-term future in terms of competitiveness and exports. Now, let's turn to the South American growing season. Obviously, we're in a world where it's not just U.S. corn, it's South American corn in particular. That's a major market for supply, and so we have to be cognizant and resonant with how are their supplies stacking up. As we look at their growing season, keep in mind it's Brazil, it's Argentina. In Brazil, you have what's called the second season or the safrinha corn crop, which is later in the year. So right now we're really talking about Argentina and first season Brazilian corn production. And what we see when we look at the 10 key states in those growing regions, these are Argentinian and Brazilian states ordered by importance. So Cordoba in Argentina, Buenos Aires in Argentina, Santa Fe in Argentina, Minas Gerais in Brazil. These are the top first season corn producing states. And what you have here is a bar chart showing the last 45 days of precipitation versus normal. And every one of these states is either pretty significantly below normal or way below normal. So we see at the best case, 25% below normal up to 50% below normal. So we see a fairly sizable deficit in terms of precipitation. And what that's translating to is the crops are rated pretty poorly compared to historical norms. So Argentina's corn crop is rated about 24% good to excellent versus 45% last year. In Paraná, which is one of the major first season corn producing areas, only 77% good versus 92% over the last 5 years. And this is the lowest it's been in 5 years. So still some time left, still some time for the moisture condition to change, but with La Nina firmly entrenched right now, it seems unlikely this is going to make a huge change in the coming month or two when is kind of the critical growing season. So as we look at corn, we see the market that we think has still got a little more upside here. We're looking at fair value for March based on the fundamentals we've just sort of laid out, somewhere around 430 for March. We see the potential to get up into the 450 to 490 range, especially if this dryness persists for the next 60 days in South America. We think that really sort of provides more of a second leg up in this market. For 2021, I still am looking for these 21 prices to get into the 425 range at 405 to 415, sort of where we've been trading here of late. I'm not really excited about that price. I think there's going to be more upside as we move forward. With beans, a similar story. We have, the old story in beans is that, we know China. China is an aggressive buyer of beans. Their bean buying is going to be record large this year. They're recovering from the ASF and they're trying to ramp up the hog herd. All of that is well known.
As Kevin was saying, China and their bean buying habits, they are looking to buy a record amount this year as they do recover from African swine fever, not only because they are rebuilding their hog herds, but also because some of their other herds, their other animal herds, have been increasing in size as they dealt with smaller pork supply. So this is helping support the U.S. export program. Sitting at 2.2 billion bushels. Commitments to date are running very well ahead of recent years and actually at record levels. So we are on par to hit this export total. And what Kevin was going to point out is that a couple of years ago we were looking at ending stocks levels and stocks to use ratios that were very large historically, and we are eating through that. The shift in the soybean S&D has been significant, like it has been with corn versus 6 months ago. Not quite as significant, but certainly to a place where we are moving to a stocks to use ratio that is below the 5% mark and closer to really the 3.9 to 4% mark. So this has been overall supportive to the soybean market. Oh, there you are, Kevin. Kevin, we can
100 and basically the corn imports, the rest of the world imports for soybeans have also gone up as well. And you can see, U.S. crush numbers, they don't move substantially because we just have a fixed capacity. You can't really crush beyond it, but crush numbers continue to be strong and export numbers continue to be strong. So again, the demand story is there as well. When we look at South America's soy production potential, again, we see problems. We see, Mato Grosso in Brazil, the #1 state for soybean production, is at least a 30-year low and probably closer to a 40-year low in terms of precipitation. Paraná had a little bit of rain, decent rains in December to help get them up. And Buenos Aires and Cordoba in Argentina, the #1 and #2 states there, also below average and trending drier in recent weeks. So I think there's a lot of room for this soy number to come down. Again, USDA has a fairly lofty target on the table here, and I think that number can come down as well. So as we look at fair value, I know we touched on $12 in futures on a few weeks back. I think we're going to get back to that, and I think we have the potential to push higher. And a lot of that is driven by what I see as problems in South America. I don't think the market has fully grasped just how tight the balance sheet is and that any sort of supply problems in South America really start to change the dynamic. So we look for fair value in the futures for 2020 around 12.50. And for 2021, I wouldn't be surprised to see us at some point get to $12. We're a long way from there now. We're in that 10.50 mark, but I do think we have a ways to go to get to fair value. So with that, let me turn it over to Regina.
Hi, thank you, Kevin. So now let's talk about my favorite market, which is wheat. And wheat has not had the same interesting year or the same huge shift as corn and beans have had, but we have had some interesting developments the past couple of weeks. And basically what's been happening is while corn futures have been gaining strength, this also has been supportive to the wheat market. And COVID has been another actually supportive element to the wheat market, largely because of consumer buying habits. But this has all faced some pretty hefty supplies out of Russia. Australia also has its second largest crop that it is harvesting right now, or should be about done. But some of the good news is the Northern Hemisphere crop, the winter wheat crop in general, has been off to a very dry start. The Southern Plains, very dry. Russia's key winter wheat producing area is very dry. So the crop did go into the ground in dry conditions. On the flip side, though, we do expect higher acreage across the globe. So we're going to have to continue to see some dry weather issues in the spring before we get very concerned about substantial production cuts. Like corn and beans, though, and as one of the elements that Kevin was saying earlier, our U.S. stocks are moving lower, and that is a great thing, particularly for hard red winter. We are seeing a pretty big drawdown in those stocks. I'll touch a little bit more about that and how that impacts spreads here shortly. But our stocks numbers are moving lower. We're going to be sub 900 this year. The potential to be sub 800 or right at 800 for next year, depending on the problems that we see into the spring. So this is all a positive from a price perspective. We had not had stocks below the 900 million bushel mark in several years. And again, a lot of that is that with we're losing a lot of the hard red winter stocks. So that overall is a positive. Unlike corn and beans, when we think about exports, even though those programs are off to record starts, for wheat, we're at an average year. Okay. However, we have been gaining some competitive edge here lately. China also is in a trade war with Australia, and that is leading China to come to the U.S. and Canada for more supplies than what we normally would see. Plus, China, as Kevin did mention, has been dealing with smaller corn supplies. As a result, we think they are increasing their feed wheat usage. So this also has resulted in China buying some additional wheat supplies too. Russia's been kind of the wild card this year. Several months ago, we were cutting back production. Then we added on several million tons to it. And here recently, as that country deals with inflation, we are seeing that they just added an export tax onto their wheat exports, and the quota remains in place. And all this is going to start on February the 15th. In a nutshell, it has not significantly altered our view on what will be exported out of Russia. And what has happened consequently overnight is essentially their domestic price and their export prices have decreased, which means on the export front, even though they have this additional tax in place now, they actually still they may be competitive to some destinations. So we're not going to see, in my opinion, a big shock here from this implementation from Russia. However, that doesn't mean that they're not going to take further measures moving forward. So we'll just have to keep an eye on what does happen to Russia and the export program. But at the end of the day, a tax on their exports and a potentially lower export quota, these are all pluses for the U.S. export program. We can go ahead. So let's talk about La Nina and wheat. I know that Argentina and Brazil are getting a lot of the center stage when it comes to La Nina because that's what's going on down there right now in their growing season. They are dealing with these impacts, and of course, it generally is resulting in drier weather. We wrote about this in the weekly recently, and what La Nina can do to the southern plains is bring in this dry weather. Okay, we've already been dry in the southern plains. The crop went into the ground dry. It hasn't received much moisture. And what we found is when we looked at years where La Nina was present. There is upside risk to Kansas City futures on the presumption that production could really be, we could really lose some production in the Southern Plains if this La Nina weather impact remains. So that does lean a bit, certainly positive for next year, even though we do expect acreage to be higher for the U.S. and Russia. This La Nina does bring in some upside additional risk to the market, particularly on dryness concerns in the Southern Plains. So we'll keep an eye on that and see how that pans out moving forward for the wheat market. But this is key. Hardwood winter wheat stocks have been declining. If we get a production problem, then that's going to help push Kansas City. Okay, and that could mean that we see a reinversion of the Chicago-Kansas City spread. So let's go ahead and move on to the next slide. And I'll talk about that for just a second here. What's been happening recently is Chicago's been trading at a premium to Kansas City, at a premium to Minneapolis. Okay, basically that tells us that we have strong or lofty high protein stocks versus Chicago stocks or softwood winter wheat stocks. Yes, that's true. What the risk is this year is with higher acreage in Europe and in other places, we are expecting that to favor bringing in Kansas City, potentially to being higher than Chicago. Depends on the severity of the spring weather in the U.S. Southern Plains and what happens in Russia as well. So we do think that Kansas City will gain on Chicago. At this point right now with Minneapolis, what we're thinking for next year is that Canada's probably losing spring wheat acres to canola. And so we're not as bearish for Minneapolis as we have been before. So we may actually see these markets kind of revert to what quote would be normal trading if you were to look at it 5 years ago. But right now we are in a position for Kansas City to be gaining on Chicago in the next few months. So with that, I'll bring Kevin back in and kind of wrap up some of our takeaways. Hey, Kevin, there you are.
So yeah, good job, Regina. Let's just kind of hit on the key highlights. Corn and beans, we see upside potential. The recipe for a rally, in my opinion, continues to be strong. We've got stocks that are going down. We have demand that is strong and growing, and we have relatively cheap priced U.S. values relative to foreign competition. Regina, wheat, kind of different story maybe?
Yes, yes, it is. It's kind of a mixed bag. If you were to assume that weather was going to be normal, then there certainly is downside risk because we've got rebounding acres expected in the U.S., but really in Europe and Russia, and those are the two largest exporters. But moving forward, spring weather is going to be key. If La Nina does remain a factor, there is risk that we lose that production total in the Southern Plains, that we eat away at some of that hardwood winter wheat, and overall that leans supportive. And certainly with what's going on in the feed grain market in general, we talk about China buying a lot of corn. That's not all they're buying. They're buying sorghum, they're buying barley, they're buying peas, they are buying feed grains in general, and this too is lending support to wheat. So we're not as bearish as we were several months ago in respect to what could happen to 21 prices, but do they come off these current levels? Possibly, if we do get cooperative weather in the spring.
Yeah, good point. I do think we want to touch on 2021, but let's go back to the 2020 crop and let's revisit what the poll said and where you guys all sit in terms of your 2020 marketing, especially with corn, and we'll try and share some insights on how maybe to approach it given what we've laid out here.
So 28% of people said 0, 29% of people said 10 to 30, 24% of people said 30 to 50, and 19% said more than 50. So it's kind of an even spread, I would say, of 28, 29, 24, and 19%.
Right. I would call that pretty much a uniform distribution. Everyone is all over the place. So, Regina, I mean, maybe let's come back and let's talk about, what would you do if you got a lot of your crop left, and what would you do if you pretty much sold it all? And so let me start kind of with my perspective on corn and beans. And I think corn and beans are a similar story. I probably won't treat it differently here in this conversation. But, if you have a lot of your crop left, then, congratulations. We've had this kind of U-shaped market that caught a lot of people by surprise. And so, you're sitting on kind of a really good situation. You have a lot of your crop that you haven't priced, you haven't sold, but don't lose sight. And even though we're bullish, don't lose sight of the fact that markets can change. Markets cannot always do what I expect, what Regina expects, or what anyone expects. They're a dynamic system. And so we have some ideas that, you should be, looking for $12 beans and probably 440 corn. But, even if we get to that, I wouldn't say just sit on your hands, start moving the needle, doing it kind of systematically. The other thing I would suggest, and we talk about this in one of the fitness bootcamp videos later this week, it's in the risk section. And I talk about how you can use options to kind of re-own grain when you want to sell physical grain. And so I think a good strategy in a rally environment like this is to, let's say you get a 20 to 30 cent rally, move some physical grain, you sell it in the cash market, but you re-own it with, say, a call option or a bull call spread that is a limited risk trade. And what that does is gives you more upside potential, but limited risk. So, you hope the market keeps going up, but if it doesn't and it drops back, you've only lost, 20 cents or whatever the number is that you paid for that option trade. And so it's a low risk way to sort of stay in the market. Conversely, on corn and beans, if you haven't sold, or if you sold everything you want to re-own here, I might dip my toe back in with some options trades. I think options trades are a good way to kind of get back into this market. Again, we see upside here in corn and beans, and especially with the dryness in South America, I do think there is more upside. So looking at an options trade that gives you some upside with limited risk, I think might be a reasonable thing to do. Regina, on wheat?
Yeah, these are great opportunities for selling. If you are sitting on any 2020 crop, could we go higher? Just like Kevin said, if I knew the answer to that with 100% certainty, I wouldn't be doing this presentation. But what is clear is that we have great opportunities right now with pricing. There is going to be some risk to the upside in the near term. A lot of it has to do with Russia, and if they do decide to actually restrict even more what they could be exporting, or if they want to up that tax there. And then overall, again, remember, COVID has been supportive to the wheat environment as a whole, whether it's soft wheat or your harder wheats or your pastas. So, is there some downside in the near term? I don't think there's substantial downside, but at the same time, there is risk that we will lose some prices into the new crop year. So as as we suggested with corn, if you do have some wheat left, take your systematic approach. Let's sell some of it at these levels, and then when we move higher, sell a little bit more. When you're looking at 21, we've had some opportunities to lock in some great prices there as well. But if you're in the Southern Plains, of course, there is risk that you do get a dry growing season with La Nina there. So with 21 crop, you also want to be systematic. Kevin, what do you have any comments on 21 corn or beans?
Yeah, good point. I mean, we've mostly sat on our hands on 2021. We still look for better prices. I'm friendly, especially for beans. 1040 beans in this market or 1050 beans in this market is not something I want to be selling into. So, I think it's really early in the season. We have problems in South America. I want to see how those play out, but I do think we start to get into the 420, 430 range for 21 corn. We start to get $11-ish for 21 beans. Then we start pulling the trigger a little bit. But again, there's a lot of ball game left on 21. But I do think it's going to be a much different environment than we've had the last 2 or 3 years.
Yes, I agree. I certainly agree with that. So with that, and with kind of wrapping up our view on what the 2020 situation is and some recommendations, I'd like to take you through just kind of our approach to grain marketing and some of the steps that we take, just to give you a bit more information about what we're doing and quote the black box or behind the scenes. And so I'm going to just walk you through some of the steps that we take when we do issue recommendations, or what we're doing in the background. And basically what we are trying to do is we are trying to, of course, maximize returns, but subject to, right, the timing of the market, the price, fundamental aspects, risk that could be ahead of us, expectations on prices, as well as trying to cater that to you in your particular situation. And that's where your FMA really comes into play. So we really want to manage your risk exposure. So that's what we are trying to do. We're trying to minimize risk, and that's one of the reasons why we sell across a pretty broad, a pretty wide calendar when we are issuing recommendations. We also tend to be very disciplined and systematic when it comes to our recommendations and the research that we're doing, and then the recommendations that we are making. We do a lot of our analysis based on fundamentals. Okay, so we're not using gut feelings. We are looking at the numbers, playing through scenarios, looking at weather, etc. Not using our gut feelings. And then also we want to be transparent. We want you to know what we are doing, and if you do have questions, certainly reach out to your FMA, and he or she can send that to us, and we'll be happy to answer it. So I just want to take you through a scenario here in just a second, but basically you face two types of risks, and one is financial, and then the other one is production, right? So production risk, a lot of times that's weather-based, financial, based on all kinds of things. So we want you to work with an FMA, and we want you to have a plan in place that caters to your needs. Okay, and then also we do have a wonderful database of bases, levels, and quotes across the U.S., and so we want you to be able to take advantage of those opportunities. We also like to make sales across large time periods, and we do that to help spread risk. Okay, we want to utilize strategies, and we want to optimize these opportunities when markets do shift. And as Kevin did mention earlier, we have had a fundamental shift in particularly the corn market, but also beans the past 6 months, and because of that, we have altered our strategies. We also like to plan at least 1 year in advance, and then start making sales when we do see opportune times. So let's go ahead to the next slide. So remember, we are disciplined. If we miss a trigger price, we do reevaluate the situation and we adjust. Right now, we do have a recommendation in place on $12 beans. We hit that level before the recommendation went out, but we are looking for that again. And we have been reevaluating some of our positions this year, as well as our target levels as the fundamentals have shifted. We're systematic. We do set goals. We have predetermined percentages of overall expected production levels that we want to have sold by certain dates, and that is also to help spread out that price risk. Okay, so of course there's always going to be risk involved when we hedge your crops, or when you're hedging your crops, and waiting until you get this certain price and then selling all of your crop is not really the approach that we take. We tend to be much more systematic, and we want to work with you at spreading out this price risk and marketing your crop at opportune times. And I'll touch on the fundamentals here in just a second about our pricing decisions. But you've got local FMAs. This is a great time where you can sit down with an FMA one-on-one and have a session, a personalized session with an advisor. He or she can walk you through some of our offerings, especially on the cash side and the basis quotes that we do have, and walk you through, what we are doing week to week, and then also through our weekly newsletters and our daily newsletters that give you information every day. But let's talk back about the fundamentals that do help drive our pricing decisions. Again, these aren't gut feelings. We are looking at the numbers and making decisions. And we look at both supply side and demand side impacts. Okay, and on the supply side, it's the obvious, weather, condition ratings, acreage expectations, yield and production, and then also some of our member polls or survey information. And I want to point out that this isn't just limited to the US, okay? We're looking at this stuff for our major exporters, okay? Because when a major exporter has a lower crop, obviously that could benefit the US. So it's not just for the US, we are looking at the global picture. On the demand side, we're looking at trade volumes and flows, who buys what, where are they buying it from, at what price are they buying it at. Government policies, huge, as Russia just showed us. Government policies have a major impact on trade flows, also our competitiveness, which we did touch on earlier, and currencies. And these are things that we are following on both sides of the spectrum, supply and demand, to try and come together to see, okay, is today's price undervalued, overvalued, or is it a fair value? And what do we think will happen in the future? So here I just wanted to walk you through the 2019 corn example. And I'm not going to take you through all the trades that we made. The trades are in the taller table that's on my left. And then what I really want us to focus on is the smaller table that says the many ways to show success and failure. And the reason I want to show you this is because you know, you may use us as your main marketing advisory tool. You may have some, you know, other people that you're seeking advice from. But what I wanted to point out is that it's easy. Well, I will say it's easy. It's you can certainly make numbers to work in your favor when you are a marketing, when you're trying to sell your marketing ideas, okay? And so for instance, that's what I want to walk you through. So in this table right here on the first column, it says FBN average future sale price, and this was for the 2019 corn crop. Our average sales price came in right under $4 at $3.95, and you can see that we started selling in August of 2018 for the 2019 corn crop. Okay, so we started selling a year basically ahead, and our average sales price for our future sales was $3.95. Now, when we included our buyback trade, so Kevin mentioned option strategies, et cetera, earlier, it bumps that price up to about $4.07, so it adds about a dime. Now, what do you compare that to? What is the benchmark you compare that to? So if we were a marketing firm trying to gain your business and we weren't being transparent, perhaps, what could we compare that to? You know, what's the starting point? Is it the marketing year average nearby futures? So that would be futures, the nearby contract starting step 1 of the harvest year all the way to August 31st of the second year. In that case, the nearby futures price is $3.55. Okay, so it looks like we did really, really well. The high that year on the nearby contract was a little over $4. So in that situation, it looks like we did okay. But when we calculate the price starting in August of 2018 through June of 2020, which is when we made our final sale, you can see that the average price then came in at $3.91. And this isn't a tactic to try and you know, buy your business or et cetera. It's just sometimes you need to read between the lines and ask questions to whomever you're taking marketing advice from to make sure that they are presenting you with fair results. Right, because I think in this case, probably we would say, not we, or someone in the market would say, look, the marketing average year price for nearby futures was $3.55. We did really, really well. Well, we also started selling back in 2018. So just be sure when you are looking at someone's historical track record of trades that you're asking correct questions, you're digging into the details, and you're asking that firm what they are comparing to. So if you want to learn more about our crop marketing and our FMAs, our local FMAs, they certainly can help support your operation. In the US, it's fbn.com/crop marketing. In Canada, it's fbn.com/ENCA crop marketing. Or you certainly can call 605-206-5695. And I do want to point out in Canada, we're not only looking at soybeans, a little bit of corn and wheat, but we also look at canola, your specialty crops, and durum, barley, oats, etc. We have lots of crops that we are looking at in Canada, and we are happy to help you market those items.
Okay, thank you, Regina. Thank you, Kevin. I think we had a few questions come in. So Kevin, I'm going to start with you really fast because as much as we love technology and, you know, all of these meetings and webinars, sometimes we do have little mishaps here and there. So we had a question. You were talking about ASF and the obvious effect on Chinese demand, South American weather when you cut out. Can you recap how that affects U.S. exports and how it affects 2020 and 2021 marketing strategy?
Right. Thanks, Kelsey, and thanks for the question. I apologize. Some internet snafus. You know, I think, you know, we saw 2018 with kind of a double whammy. We had the ASF in China. We had the trade war going on. And I think the good news is, you know, 2 years later, we're past a lot of that. You know, ASF, I won't say it's gone because we don't have a cure for it, but we seem to have at least a better control over it. the Chinese hog production is moving from more local, smaller farms to really large commercial-sized farms. There's been some stories of late about just how massive these farms are. So they're trying to control ASF through technology and things like that. I do see, China's appetite to be really strong. Again, the numbers we see, 100 million metric tons of imports of beans for China this year. I think those are legitimate. I think those are likely going to happen. That's up sharply from 82 million metric tons back in 2018. And on the corn side as well, they need to start importing corn. That I think is becoming clear. And, we haven't had that happen in many years where they needed to be a major corn buyer. So we have strong soy demand. We have strong corn demand. I think those are two stories that are going to be around for quite some time.
Okay, great. Thank you, Kevin. We also had some questions come in from our viewers. This one is from Adam. Does a new administration pose a potential for changes in exports?
Yeah, good question. And maybe I'll let Regina talk about this too. But my perspective on the new administration is that, mostly, obviously, they're going to be focused on COVID. That's first and foremost a priority. But then the second thing I think is really environmental. And where I see agriculture sort of being a partner in this is in sustainable practices. The Biden administration or the Biden campaign certainly signaled that they viewed agriculture as a partner in sustainable goals or environmental goals. And I think sustainable ag and regenerative ag policies will probably be something we see down the road. Ethanol, I don't see a huge change in what we have in place on that in terms of renewable fuel standards. Maybe some small refinery setbacks, where we had small refinery exemptions in the last 4 years. Those may go away. It's hard to say, but I think by and large, the question about exports, I don't think we're going to get into a trade war with China. Somewhat maybe surprisingly, I mean, Biden is pro-labor, he's pro-U.S., and so he doesn't necessarily have a different view on China and the problems we've had with China. He still thinks a lot of the problems are there, that they subsidize their production, they have intellectual property transfer, and so those things Biden still agrees with the former administration on. I think his approach, though, is much more multilateral. He looks at trade groups like the WTO, the G8, those kind of things as ways he's going to try and move the needle versus just an outright trade war. So I don't think we're going to see trade wars circle back anytime soon. Is my view. Regina, what do you think on
No,
trade?
I mean, yeah, I'm going to second what you said. Of course, I agree with that, and probably a lot of our trading partners maybe took a sigh of relief, thinking that at least trade negotiations would not get more difficult moving forward. But I believe that Biden's going to want the farmers behind his back and on his side. And in order to do that, you kind of have to be pretty friendly on the trade side. So I expect overall that certainly the new administration did not alter our view on what exports would be moving forward. Certainly not negative. A lot of that would be driven by supply and demand anyway. So at this point, I think net, it's a neutral to positive when it comes to exports in general.
Okay, great. We got two more questions from the viewers, one from William, one from Corey. William said, what is view on canola markets for 2021?
Sure. That's a very good question. Right now, what we're leaning towards is that we're buying in acres. We know that new crop futures, of course, are at a discount, but are probably buying in acres, and those probably are coming out of the spring wheat mix. So right now, for the near term, we're neutral as far as what prices could do, but longer term, when we get to the 21 harvest, we do think there's going to be some downside in futures on these higher price levels. And remember also that StatsCan tends to add to the canola crop. So I know they took away from it in this latest report. We may get a little bit of a boost and may find back some supplies of old crop next year. what we're seeing though for now is that our balance sheet cannot maintain the level of demand that we are seeing for this year. So that is a positive for next year and doesn't, it keeps some support in that market. But overall, on higher acreage expectations, we do expect a bit of a dip, but not a substantial decline. Okay, so we do think that futures will stay elevated relative to where we were a year ago, 2 years ago, for canola. And if you have more details, please, the North Dakota FMA, he can help. You can reach out to the Canadian team and get back with me, and we'll be sure to include you in some of our canola updates.
Perfect. And I think this was kind of a clarifying question on market advisory from Corey. You're helping the Canadian market with canola and durum. What about the U.S. farmer?
Yeah, sure. So of course we also help the U.S. farmer there. If you are growing Canadian, if you're growing canola or durum, just let your local FMA know. Our U.S. FMAs are privy to the information that we are issuing for durum as well as canola in the Canadian markets. But also something you have to realize is, that's a cash market in Canada. It's going to be a little bit different in the U.S., even though there is some overlap. But certainly with our futures recommendations and any of the analysis that we're doing, we'd be happy to share that with you. If you want that information, again, please reach out to your local FMA, and we'll be happy to share that with you.
Okay, I have two more questions here. I know we're getting to the end of the hour, so I want to wrap this up real fast. And then if you have any more questions, feel free to submit to the landing page. There's the phone number on there. I will send out in the chat. Everybody can see on their screen the chat, and I will make sure to send out how to sign up for a one-on-one with an advisor, as well as that phone number if you have more questions. This is from Brent. He said, you talked about a bull call spread on corn reownership. Can you give us an example of some targets you would be looking at?
Yeah, good question. So we reowned in March. I'm sorry, the March contract. So we did a 420, 470 type of bull call spread, and the idea is that we're buying the cheaper one, or we're buying the lower price strike, and we're selling the higher price strike. So the net premium of that, the net cost is around, I think we were paying around 15 cents for it at the time, with the hope that we get a 50-cent rally. So generally speaking, when I look at bull call spreads, I'm looking for somewhere around a 4-to-1 payout. So I want, 40 cents of upside for 10 cents of cost. That's kind of how I think about bull call spreads. And again, it's kind of where do you set the expectations? In our case, we see, a fairly legitimate case for getting into that upper $4 territory if things line up the way we've laid out. That is, South America really remains dry, the U.S. dollar continues to be weak. We think that upper $4 territory in the next, call it 3 to 6 months is a legitimate possibility. So that's why we like a bull call spread.
Okay, perfect. And my last question is, how can I get a $500 market advisory subscription coupon? Where do I sign up?
I can answer that one. You can sign up for 101s with advisors at use.fbn.com/ffb-day1, or you can call that number I mentioned earlier, the 605-206-5695.
Yep, and that is a part of our financial fitness bootcamp that we're doing. If you do sign up for market advisory or any of our other finance businesses, there is a $500 coupon. So make sure you check that out. Kevin, Regina, any last remarks as we log off here?
No, I appreciate everyone attending. Like I said, I think we have some really reasons for optimism, a far different paradigm than what we've seen the last few years. So, don't lose sight of being disciplined, as Regina talked about. Discipline's important. So, you get a 20, 30 cent rally, start moving some grain. But there's reasons for optimism as we move forward.
Absolutely. Thank all of you for attending, and hope to see you in person next year.